Welcome back, traders, to StrategyQuant's channel. My name is Ali Casey. In this video, I will go over seasonal patterns. So, seasonal patterns or cyclical patterns, they occur during the year, and how can we use them to make money? So in the coming slides, I will show you samples of seasonal patterns and how to use them and what do they mean. A seasonal pattern is a term used to describe recurring and predictable patterns in any instrument. And the reason they are useful because they have an edge. They are not an average. Their statistical significance is more than average. So since they have an edge, we can use them to generate an alpha or basically make a profit on them. The patterns tend to repeat daily or monthly or intraday or yearly. It depends on the instrument. And every financial instrument has some unique patterns. Some of them has more than one pattern during the year or during the month or during the week. Of course, the seasonal patterns are not by chance, while some of them do occur by chance. But most of them have some fundamental reasons that drive the pattern to occur on cyclical basis. So these patterns occur in many markets. For example, indices. They occur in all indices around the globe. And here I represent NASDAQ and DAX 30, which is the German index, and Nifty 50, which is the Indian index. But they occur all over the globe with different returns on the alpha generated. Of course, they occur in all stocks for different reasons, sometimes due to earnings or sometimes due to the factors that drive the stock, for example, mining stocks or shopping stocks. And of course, they occur in currencies because of fluctuation in interest rates or bonds or seasonal buying from the Feds. They also, of course, occur in commodities. And this is actually the original seasonal patterns came from commodities, because commodities by default, they have their seasonal patterns. Agriculture patterns, or for example, here in Canada, the price of gas oil, heating oil, and oil itself always goes up and down in the summer and in the winter on really predictable pattern. And then, of course, they occur in bonds, in cryptocurrencies, while they are relatively new and there is not enough data on it, but they do have also some patterns. And of course, they occur in other tangible assets like real estates. Again, here the price tends to go down in the winter and go up in the summer. Now, the periods will depend heavily on the instrument itself. Some instruments will have several periods, and some of them will have one period per year. Of course, everybody knows the annual predictable patterns, which happens either in summer or winter, or on option expiry or on a triple witch. Earning calendars or taxes, where the money flows out of stocks and go back in January. Around holidays, for example, the shopping season. So all the shopping stocks like, Shopify, Amazon, and Walmart, Target, all these, they usually go up before Christmas, before the major shopping season. And then there is intra-month and intra-week and intra-day. And these will heavily depend on the calendar day. So remember in the video we did before about the bias, that was on daily patterns, and you can find weekly patterns and intra-month patterns where, for example, because of the money flowing into the funds that trades momentum, which they usually trade around the end of the month. So there is a tendency for the price to go up before the end of the month and then go down after the end of the month, or actually on the beginning of the month. And those are all also considered cyclical patterns or patterns. And then there are events that reoccur on some cycle, like oil inventory reports, which happens every, I think, second Wednesday. And you can find a pattern around those reports. For example, the labor report also have a pattern. And of course, the FOMC meetings have a pattern. And if you have enough data, then you can find the pattern easily. Now, the way to use a seasonal pattern is first you use it as a market regime. So, for example, you have a, let's say, breakout strategy. We know that for example, now the coming period is a long bias period for the S&P 500. So if I have a breakout strategy on the S&P 500 that goes long and short, then I might use it to filter out the short strategies where I will not trade the short, or at least decrease my position. So I will trade, let's say, the full position in the long breakout, and let's say a quarter of the position in the short breakdown, or don't trade the breakdown at all. Also, you can use it to filter the stocks inside the index. So again, if you're trading the S&P 500, and again, we know that it's a long bias before Christmas. So if I'm trading, let's say, Apple or Microsoft or Google or any company that's inside or part of the S&P 500, then I should focus on, again, the long side and not the short side. It can be used as a filter for the same instrument or for the instruments that part of the main instrument. The other way you can use it as an input. So if you're building a strategy, you have, let's say, your time frame and your indicator, and the third input is the seasonality. So let's say, again, I have the oil, let's say, goes up around April. So if I'm building a strategy for a breakout for oil, then in the month of April, I will not take the short strategies. And this will be part of the building process. So it's not only long, the strategy goes long and short, but it will not go short in the April month of the year. And of course, it doesn't have to work all the time. So you can incorporate other indicators. So for example, if oil goes up every April, then I might add a condition that the price has to be above the 5-day moving average. Because remember, no strategy is 100% gonna work all the time. So seasonality is like any other strategy. It will have like a winning percentage and a profit factor. It's like any other strategy. So you can also use it like any other strategy. The other way, of course, to use the seasonal strategy is directly. The pattern itself is the signal. So for example, if the S&P goes up before Christmas, then we take that signal as buy, and then when it ends, we take that signal as sell. So that's a strategy on itself. The most known seasonal pattern for everybody is the one most likely you heard of, which is called sell in May and go away, or it's most probably called in everywhere else the Halloween effect. It's basically the summer is very slow, everybody's on vacation, nobody's in the market. So usually nothing happens in the summer. Again, that doesn't mean every summer nothing happens. It's just most likely the edge is with nothing happen every summer, and then all of the returns happens in the winter months. And actually we can test this, and I did the test here on multiple markets. And you can see here I picked the countries with the data I have. So this is the data I have. Some of them started in 1970 and some of them later on. And as you can see, this pattern shows up in all of them and more prominent in some of them than the others. So here in Canada, almost all return comes from the winter months, which is when you buy first day of November and you sell last day of April. And if you see China, which is the Shanghai composite, is the same thing. And Korea also the same thing, where all the returns comes from the winter months. And then the other countries, they have some negative and some positive summer months. For example, France is negative summer months, while India has positive summer months and positive winter months. This is obviously strange, but it doesn't have to be, because they've been in a bull market all these years. The bull market tends to erase the weak patterns in any instrument, and of course bear market is the opposite. But because bear markets usually are so fast, so you tend not to see it. But for example, last 10 years we are in a bull market, so any weak cyclical patterns that happens in the S&P 500, you cannot see it clearly, because it will not show up, because of the bull market all the time is lifting the index up. Nevertheless, the pattern exists, and the fact that it exists in different geographical areas around the globe, that gives it a statistical significance that you need to trade these patterns, or at least you need to use it as a filter. But since it's a long pattern, then it doesn't make sense to use it for daily breakouts. And again, let's use the S&P 500 as an example. If I have a breakout strategy on the S&P 500, like I will not forget the shorts in February because it's part of the long bull run, because it's a long time. Like you're going from November to April. That's a long time to use it as a filter for a daily strategy or even intraday. Now, you might ask, okay, what's the significance of this? Because remember, the fact that it's seasonal, yearly, there's even 70 years, that's 70 trades. The way to calculate the statistical significance, it's like trend following. If any of you have done testing with trend following, long-term trend following, it's the same problem over there. You get 7 years worth of data, and again, you might have 40 trades. And the way you get, not around it, the way actually you solve this problem is by analyzing multiple markets and multiple, let's say, trend following lengths, or in our case, multiple markets and multiple seasonal patterns. So in that way, you can get a lot more relevant data to test. And there is a study that's been done. It's called Global Factor Premiums. You can check it on SSRN. SSRN is a website that hosts all the academic papers, and it's actually a great source of material to get new ideas to test for strategies. If you're not into reading or math, then it's going to be hard, but still you can get the gist of most strategies and then get some ideas to test in your own strategies. So it has a wealth of, there's probably 300 papers written on momentum and trend following. And anyway, this I put the ID here is 3325720. You can read it. They did the study, and this is the let's say the summary of the study. They did it on, I think, 250 years worth of data on 4 asset classes and 68 markets. So the reason, again, like I told you, is to generate more trades to make it statistically significant. And they tested several strategies, and of course they have their own assumptions. But still, the seasonality came on top, and even if you say, this is exaggerated, let's say it's in the middle. So it's up there with momentum. So that's, I would say that's excellent. And of course, remember, we are algo traders. That means we don't trade one strategy. So this is just another weapon in our arsenal to trade the market. It's basically you want to add as much as strategies in a portfolio to have different drivers driving your alpha. So this concludes that the seasonality have the highest return over this period, and they have the highest Sharpe ratio. And Sharpe ratio basically punishes deviation, punishes high standard deviation. So it punishes even on the upside, by the way. So Trend following usually gets a bad Sharpe ratio, but they make money. It's just because their return is lumped on the fat tails. And if that jargon is just too much, just ignore it. It's just I put the Sharpe ratio there because that's the standard used everywhere. Although even myself, I consider it not the best way to measure a strategy. So, okay, what's the point of all this? The point is I've been doing all these videos to generate random strategies, and the tools available for us is it has to be honed to do what you want. So you don't want to be sit in the toolbox. You want to build your own box and make the tool work for you. I always look for ways to automate my workflow and basically to work less and make the computer work more. And so the point of this seasonal strategies, I'm gonna teach you how to add seasonal strategies to your portfolio on top of your breakout and mean reversion and so forth. The reason is because there is no one strategy that's gonna work all the time forever. Even long-term trend following, which has been working for the past 800 years, they have their bad years and sometimes decades. Value investing, like Berkshire Hathaway, what they do, also they have bad decades. So there is the point is there is no one strategy that's going to work all the time. Each strategy, it doesn't matter how long or short the time frame it trades, it's going to have some strength and some weaknesses depending on the market regime it's trading. When you do your own testing, you will find, and I have a blog on my website that shows this in a clear way, and it's been done by Ray Dalio, which is, he's an iconic hedge fund manager managing multi-billions, and he proved that with a paper that if you add around 25 non-correlated strategies, you'll have the best return possible. The goal is always to add non-correlated strategies, even if those strategies are not excellent. If you have a strategy that, like for example, if you have value and trend following, they don't work at the same time. So, but their return streams will be added together and not their drawdowns. And when you do the testing, you will find that sometimes let's say if two strategies make 30% each, so the return, if you combine them in a portfolio, their return will be 60% per year. But if their drawdown each is 20%, their drawdown in a portfolio will not be 40. Sometimes we'll stay at 20, and sometimes will be even less, and sometimes will be, let's say, 25. But it will never be 40. Because by definition, you're adding a non-correlated strategy. So therefore, the drawdowns are not correlated. So that's the advantages of a portfolio. When you think about it, your portfolio should not consist of different assets. That should be the last part of the puzzle. And here I put them in a priority that I see it the correct one. So the drivers are time frames. So let's say you can build a portfolio of the S&P 500 only, but the strategies have to have different time frames. So you'll have one strategy that trades from 8 to 10, another strategy that trades 2 to 4, another strategy that trades swings, another strategy that trades only on Tuesdays, another strategy that takes the momentum end of the month, and you get what I'm saying. It is the same symbol, I don't care, but the driver of the strategy is totally different, and therefore that will be not correlated. This would be priority 1. Priority 2 is the direction. So again, if you have a long breakout and a short breakout strategy, even if both of them on the S&P, then by default they are not correlated. They will not take the same position. It might happen rarely. Let's say out of 100 trades per year, let's say twice is going to happen where they will take the same position opposite each other on the same day. But on the 98 trades during the year, they will not trade on the same day. And then on the style. So breakout strategies on intraday is not like mean reversion. In fact, breakout is the opposite of mean reversion. Because remember, with a breakout, a mean reversion is a false breakout. That's what a mean reversion is. And then seasonality, which is totally different driver. And then trend following, which is again different driver. Momentum, trend following, and breakouts, they do share some similarities. But remember, if we added the time frame in the beginning, then they will have different returns. And then value, which is opposite as momentum, and then pair trading, that's another style. And then I will go to assets. So once I achieve all the above, then I can go to assets. And now this, let's say I build a portfolio of that. Now my second portfolio will be, so my first portfolio was on oil and let's say S&P and gold. So my second portfolio will be, let's say, on stocks and bonds and cryptos. Basically, it's you want to diversify the drivers, and the last one is the assets. And that's how you get the most non-correlated strategies. But at the end is all about testing. It doesn't matter what I say, because you might have a long two breakout strategies working beautifully on two markets and non-correlated. So that's why you need testing. It doesn't matter what I say, what everybody says. You always need to test. Like, yes, I'm giving you my experience, my knowledge, but it's always have to come back to you and testing. And this testing is not about me or anybody else. This testing is for you, because it's psychologically, it's very hard to stick to any strategy in a drawdown unless you know what it's doing and how it is doing that. And the other beautiful part is when you have 20 strategies, then that strategy losing on that day or that week or that month doesn't matter, yes, because you have another 19 or 25 or 30 strategies trading different things in different time frames. Now I understand, of course, trading 20 strategies is not easy. You need capital. But remember, this is a journey. Trading is a journey, and you are into this for the long term, hopefully. And the target should be is your portfolio. So the target is not to build one strategy and make a living of it. The target is to build a portfolio and grow your account, and hopefully you will reach a point where you can receive an income from that account. So I hope that was useful to you. And as usual, please share, like, and subscribe to other traders so they can get you something out of this video. This is a primer to my future coming videos, where I'll be diving into seasonalities, and I'll actually also give you free strategies on seasonal patterns. So until the next video, stay safe, and I'll see you soon.